I'm Jorge with J&J Insights. If you already own index funds with a three-fund portfolio, you've done the hard part. But your index funds give you one thing, the stock market. The next 4 minutes, I'm going to show you the 6 asset classes beyond them: real estate, hard assets, and private markets. How to add them as a disciplined layer on top of what you've already built. This is the Alternative Investors Field Guide. Let's go. There's one idea that makes alternatives worth having. True diversification means owning assets that don't move together. If you own 10 different stock ETFs, you're not necessarily diversified. You're concentrated in the stock market. Real estate, gold, and private markets have historically low correlation to stocks. That means that if the market drops 30%, these assets don't necessarily drop with it. That's a diversification dividend most investors never claim. That's critical. Let's help you build this. Real estate has 3 entry points at a very different effort and capital levels. REITs are the easiest. $1 daily liquidity, no landlord headaches, VNQ from Vanguard gives you hundreds of commercial and residential properties. If you want direct ownership, a rental property gives you cash flow and appreciation, but it is high effort. You're now a business owner, not a passive investor. Syndications will let you own a share of a large deal, like apartment complex, commercial building, without doing it. The minimums can be high, and you're locked in for years. You also need to be an accredited investor for the most part. So start easy with a REIT, ETF, and build from there. Assets are the thing that exists outside of the financial system, things that can't be inflated away. Gold is the classic, 5,000 years store of value. Held by central banks, you can use IAUM from iShares to give you gold exposure with an expense ratio of 0.09. Silver adds an industrial use. Think solar panels and EV batteries which run on silver. Bitcoin is the digital version of this. 21 million coins, hard limit, no central bank. IBIT from BlackRock makes it easy as buying a stock. Broad commodity ETF like PDBC tends to spike when inflation rises, exactly when your stock funds are struggling. Key rule: buying all hard assets into 10 to 15% of your total. Private markets are where the highest potential returns live. The most risk lives as well. Angel investing means putting capital in the early stage startups. Most deals go to zero, but the winners can return 10 to 100 times your money. Only for accredited investors, only with money you can fully afford to lose. Small business acquisition is actually the most accessible high return alternative for most people. You don't need to be accredited, and SBA loans can lever your capital significantly. Private credit, lending directly to businesses at 8 to 12% yields, is growing. Platforms like Fundrise and YieldStream. These are illiquid, and that liquidity is exactly why the returns are high. So how much should you actually put into alternatives? Practical starting point for most folks, 10 to 15% of the investable assets. Conservative investors can start at 8 to 15. Weighted towards REITs, moderate investors can push it up to 25%. And in hard assets and some private credit. Aggressive portfolios can go higher, but only if you have the support. The sequencing matters as well. Build liquid alternatives first, think REITs and gold ETFs, then private real estate, then private credit. Angel and equity investing come last, and only if you have the appetite and the accreditation. Don't put illiquid capital in before you can afford to lock it up. The 7 rules. Rule 1, foundation first. Alternatives come after your index, never instead of it. Rule 2, only invest what you can lock up, which is why those returns can be higher. It does require real commitment. Rule 3, diversify within each category. One rental is not real estate diversification. REIT ETF with 200 properties is beautiful. Understand what you own. This is the rule active investors most often skip. If you can't explain what you own, who operates it, how you actually get your money back, you're into speculation. Rules 5 through 7. Alternatives have complicated tax profiles. You need to know them before you invest. Gold ETFs are taxed as collectibles at 28%. Real estate has depreciation benefits, but they recapture on the sale. Crypto staking income is ordinary income the year you earn it. Know before you invest, not after. Rule 6. Fees in private markets are steep. 1 to 2% management plus 20% carried interest is common. Run the net of fees math. A deal that looks great at gross might be mediocre after fees. Rule 7. Patience is the actual edge. The alternative premium is real, but it's paid out over years. Investors who capture are the ones who commit and stay committed. Alternatives attract sophisticated sounding pitches. Here are 6 red flags. Anything that says guaranteed returns. No legitimate alternative guarantees it. If you hear that word, no audited financials. Any serious operator will share them. Refusing is a red flag. Complexity as a feature. You need 2 explanations just to understand how you make money. Complexity is hiding something. Social proof over substance. Viral deal rooms, celebrity endorsements. This is marketing. Misaligned incentives. Always ask if the operator has their own capital in the deal. No exit plan. Every deal should have a clear path to liquidity. If they can't answer how you get your money back, that's a complete alternative investing system. Here's your index fund foundation first. Add a REIT ETF and a gold ETF. The most liquid alternatives available. Then layer in some private real estate, private credit as your capital, and angel investing in private equity commodities. Only for capital. Know what you own, watch the fees. Commit your capital and leave it alone. You want the full field guide with every allocation. 6 red flags checklist. All 7 rules in one printable PDF. Grab it at JMJ Insights. This is guide 2 of 3 in the series. Check out the Hard Money Field Guide next. If this has helped, subscribe and leave a comment.